Welcome to This Week in Money. I'm Jim Goddard. AddictedToProfits.net editor Dave Skarica warns the new high-tech darlings like 3D printing are very risky investments. OilAndGasInvestments.com editor Keith Schaefer believes oil and gas shares have hit a new higher floor price. We'll talk to Dave Skarica right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Dave Skarica, editor of AddictedToProfits.net. Welcome to the show, Dave.
Thanks for having me.
Gold has made a resurgence after being in the dumps for many months. In fact, I think people were surprised it lasted so low so long. Now it's picked up again. Is this a long-term surge, or are you still kind of cautious in this area?
I'm actually very positive. I started to turn, longer term in terms of, I'll just start about my big thesis for a longer term period. I was always bullish on gold from a long term standpoint, meaning looking 3, 5, maybe even 6 or 7 years out, even during the entire decline. But one thing I had noted in my long term thesis is that we could very well see a decline like 74 to 76, where gold lost 40% of its value. Many of the gold stocks during that time lost 2/3 of their value. And then, of course, gold turned higher and had a huge rally into the late 70s. And the reason that, in my opinion, you still should stay long during a decline like that is it's almost impossible to time it. Who knows if this would have been another little 10% drop the entire way down rather than, what it was, which was a longer drop. And then, in terms of the short intermediate term, but the second half of last year, especially the fourth quarter, I started feeling it. I started feeling that this was going to be a bottom, that the June lows would probably hold in the bullion, and they basically did, and essentially that gold would begin a large rally higher, which it did. So these are kind of like the theses that I played a part in. So I really started to load up on gold and gold stocks in the fourth quarter of last year. I thought that we would see a downward turn in November, December, which we did because of tax loss selling. And, essentially that was a third year lower for gold and the gold stocks. No one talks about that, by the way. Everyone looks at gold and talks about how last year was the first year down, but the stocks essentially fell in 2011, 2012, and 2013 for 3 straight years. And with that happening, I figured they would basically be sold out. All the sellers are quote unquote in. And the fourth quarter of last year would be a good entry point. I actually was more positioned in European stocks since 2012. And in the fourth quarter of last year, I kind of shifted a lot of that into gold and precious metals and other resource stocks because I figured that they were bottoming at that time and the valuations were good and the charts were shaping up and it looks quite good right now. And here's the big thing right now. While obviously we've had a big rally in the last week or two, we could see a short-term pullback. If you look at the chart of, say, the GDX, which is an index, ETF of gold stocks, its highs of the spring and the summer is roughly $30 a share. It closed today at just over $26 a share. So many of these gold and gold stocks can rally 10, 15% from current levels, and they'll just be starting a massive breakout. So that's where I'm getting really positive here, is that even despite this move of 20, 25% off the lows in terms of many of the gold stocks, just over 10% in gold bullion itself, actually started closer to 15% gold bullion itself, we are just kind of in early stages of the breakout.
Will China's massive buy of gold be a big factor here? Again, I hear last month every piece of gold produced in the world they bought.
I think that's a huge factor. I think that was a huge factor in putting an underpinning under the price. And what many analysts have talked about, and I'm more of a technician and I consider myself more of an equity researcher than, like an out-and-out gold bug that knows everything intertwining at the physical gold market. But from what most of my reliable sources have written about and talked about and researched about is that there was this big shift where 3 years of gains in the GLD in terms of the amount of bullion the GLD owned went out of the GLD last year, and a lot of that shifted in terms of physical gold into China. And, there's all kinds of stories and research showing that the warehouses in London and New York are essentially empty, and the warehouses in Shanghai and Hong Kong and Singapore are full. And so I think China continuing to buy is going to be a real positive underpinning. And, there's some worries about China being in a credit bubble, and I would think that actually a bursting of the credit bubble, there is not going to be a negative for gold because, people are going to go to gold if China enters some kind of deepening crisis. I'm not saying that's going to happen, and if that happened, I think that would help as well. So the real, I think, kicker comes, and actually is now the West, that if this tide is turning, and if all these Western investors decide to get in gold and gold bullion again, well, guess what? The physical stuff is all shifted east to China, like you said. They gobbled up all of last year's production, and that gold in China is not coming back. So then all of a sudden the West, it will be scrambling for physical gold and even, for just gold in general, even in the paper form. And that is when you can get the elephant through, the hole, and just everything can blow open. And I think you look at technically speaking, in the price targets, that kind of 1400 to 1450 area, which was the support, which now is resistance, which when gold really tanked April of last year. If we turn up and go through that probably becomes when people begin to scramble for the physical stuff and for gold in general. And probably a lot of funds which are now underweight gold will start seeing the breakout and getting overweight or at least market weight gold. And that's when you can see the big move really start to move higher. And I think that's a big move for the miners, because what my research has showed is that that's when the real inflection and real, leverage and profits in the miners is going to come when we get through about that $1,400 to $1,500 area. And that's where most of these miners are going to go from roughly being flat to, slightly cash flow positive to really, really making money.
And I've heard right now junior miners are being snapped up like crazy.
Yeah, I think the consolidation going on in the industry should pick up now, because I think there's a bit of a worry after, so many assets were overpaid for in the last boom in 2010, 2011. But these stocks are really cheap. A lot of them have real assets in the ground. Right now the industry average is only $15 per ounce in the ground of a junior exploration company that has an asset. A lot of them are selling at $3, $4, $5, $10 an ounce. So if you're looking at the industry average being 15, and by the way, in a good market, that can easily move up to $30, $40, $50 an ounce. But if you're looking at the industry average being 15, maybe 20 now that the market gets a little better, and you can buy one of these companies for $7 or $8 or $10 an ounce, why not do that? Like, there were companies that were taken over in the last boom, just hit a few good drill holes, and the seniors like what they saw and gobbled these things up. So I think you're going to see more consolidation. But more than that, I think you're just going to see more action and more positive price movement in the junior mining industry as they go from undervalued to fair value.
A lot of them did not survive that down period. They had to either shut their doors or, as I said, pretend that they're open for business, but really there's nothing inside the doors once you open them. Are those companies going to come back?
Oh, just so you know, by the way, just to answer this, come back, is that's an important thing to look at. Now, it's like all quote-unquote junior miners are not created equal, especially here that, a lot of them just did the typical Vancouver $500,000 financings to keep their heads above water and really are doing no drilling and just waiting for prices to rebound so they can, go and raise $1 million and do some drilling. So the ones that are right now active drilling, building resources, that sort of thing, are the juniors you're going to want to be in. And because juniors have a lag in terms of, bull markets tend to go from big to medium to small. So, the big companies and a lot of the top tier big companies like Royal Gold have really led the way out of this. And a lot of these larger companies and medium-sized producing companies have doubled off their lows. They're going to kind of lead the way, and then that will trickle down. But you want to make sure it trickles down into the quality ones. You want to own the right ones. Just don't own a 3-cent junior because, you think it's 3 cents and it's cheap and it can go to $1. Own a 3 or 4 cent company that has ounces in the ground, that is actively doing drilling, that has the ability to finance, that hasn't been keeping active even during this downtime. And by the way, that's the advantage of a bad, beaten up market right now. Like, for example, I have one stock on my list right now, and I can't really name it because it's for, subscribers, but this is a perfect example. This stock trades at 3 cents, trades at $3 an ounce in the ground, and if the industry average is $15 per ounce in the ground, it should be trading 5 times what it is right now. But these are the kind of bargains you're getting right now in the negative market. And just gold going from roughly 1,200 to 1,300 hasn't changed that. The juniors are definitely, starting to firm up, but they're not by no means booming yet. So I think now you can still be positioned in the correct juniors.
As long as they're busy.
Yeah, exactly.
So this is a case of, they always tell you before you invest in any stock, of course, do your research. You better dig deep and dig hard.
Yeah, you better hope these companies are digging deep and hard. No, not sitting in an office somewhere just paying themselves, their salary to get by during the rough times.
Silver, what's it going to do?
Well, I think that silver has more leverage than gold here. The gold to silver ratio got cheap, meaning silver was cheap compared to the price of gold. Now, silver was much more of a bubble in 2011. I remember being pretty scared when it went about $40 an ounce at that time. And, you can never get it out. I remember me and a friend of mine doing a podcast who also writes a newsletter, and it was similar to this one, and we were talking about it when silver went over 40. You know what? Time to take money off the table. I never thought silver would get back into the mid-teens, but I definitely thought that at that time it was time to take it off the table. Silver could drop back into the low to mid-20s. And if you look at the chart of silver right now, this $20 to $21 an ounce level represents a lot of resistance. We just look like we broke out today, out of that resistance. And again, that's the whole thing. Okay, well, short term, maybe we're a little overbought, but these things are just coming out of important resistance levels. And this is actually what a guy named Stan Weinstein, you look at the silver chart, the exact perfect example of this. Stan Weinstein, he called it a phase 1 bottom. And that's where a market drops, then spends maybe 6 months, 12 months, 18 months, whatever the time frame is, basing between certain price points. And after it's finished the basing, it breaks out violently to the upside. And silver, from the mid-teens to the low 20s, has fulfilled this classic phase 1 bottom. And it looks like it's now just starting to come up to the upside on that. And if you look at the basic ratio of silver, and I think that gold will turn into a bubble at some point. Not yet. We're years away from that. And silver will too. But if you're looking for the ultimate top, that gold to silver ratio was only 17 to 1. So gold was 850, silver was 50 at the top in 1980. Well, right now gold is 1,300 roughly, and silver is roughly $20. So you're talking 65 to 1. So you're talking, if we get to the same kind of ratio at the top of this market that we got to 1980, silver is going to outperform gold from current prices by probably hundreds of percent. So I definitely think you should be leveraged in silver right now. Personally, myself, because I'm an equity guy and I'm more of a stock analyst than anything else, I like the equities because if we take the gold and silver equities, divide it by the price of the metal, divide it by the revenues that they have, we were getting near bear market lows, near the 2000 lows, which we saw, when silver was $4 and gold was $2.50. So these are the kind of things that I would look at right now. And we were talking about the stock just quickly earlier, but I really like the equities here because they made some bad decisions. There's misallocation of capital, but the write-offs are all in. Most of them are now trying to make money by controlling costs, not by doing stupid takeovers. I think that this is going to bode well for them in this next market upturn.
Dave, we've talked about gold and silver and some of the bright highlights there. What about the equity markets? They had a bit of a lull. People are so worried they're going to take a major dump. What is going on there, and what are you thinking about?
I'm really bearish. Probably in the fourth quarter of last year. Again, that's kind of my thesis why I got bullish on gold, because since 2011 we've had the disconnect where gold and equity markets were rallying together and falling together until about 2011. And then as the market seemingly stabilized, the economy seemingly stabilized, and no massive inflation came from all this money printing in the short term, people kind of sold out their gold shares and kept in the equity markets. And I think the equity markets went from being in a strong bull market to being more of a bubble mode. Basically, actually, ever since the Fed started printing that $85 billion a month. I know now they've cut it back to 65 and probably will cut it back to 55 in March. But ever since that kind of unlimited QE infinity started, that's when they turned into a bubble. And if you look at sectors, especially in technology, like biotech, like social media, like .coms, like 3D printing, things like this, these are gigantic bubbles, in my opinion. These are, when you print money, you get misallocations of capital. In the mid-2000s, the misallocation was in real estate, and mostly in America and in Europe and in the developed world. This time, and even in some emerging markets and commodities, etc. This kind of misallocation is happening. Things like social media, like I said, biotechnology, 3D printing, really the technology sector. A lot of those charts look like they did in 2000. And you must remember, in 2000, the Nasdaq peaked in March, so maybe something similar will happen this time around. And I think that we're approaching like a massive top in these markets. Now, will it crash? Will it just take time to top out? Both the 2000 and 2007 markets took almost a year to top out. So that we don't know. But I do think we're getting to dangerous zones in the markets. And the one valuation method that I have been using is something called the CAPE. And this is the kind of the 10-year trailing earnings on the S&P and dividing it to the current price to get a smoothed out 10-year PDE ratio. And this kind of shows you where stocks are in the long term.
So, Dave, what does that tell you? What's going to happen to the market?
Well, like I said, in 2000 it was 35 times, and of course we had a bad bear market. It was around 22, 23 times earnings, and usually, by the way, north of 20 is expensive in 2007. And right now it's 25, which is, of course, the highest since, like it said, the 2000 stock market bubble. So I think it means that we're going to see very mediocre equity markets in the United States in the next, 2 to 4, maybe even 3 to 5 years. And unfortunately, you have to think that when the last two times it got this high, back in 2000 and 2007, it wasn't just like the market did nothing for 2 years. In each case, we had pretty violent bear markets. So I would have to lean on the side of that happening, especially with this market being propped up by money printing and the creation of new bubbles and biotech and social media and 3D printing and things like this. And I would think that stuff is probably going to end pretty ugly to the downside.
People seem to be in love with this concept of 3D printing. It makes sense in so many areas. But they're also expecting it to replace, massive factories in Asia overnight, it seems. That probably couldn't happen physically.
Well, yeah, I think that's what you get in a bubble, right? See, what happens in most of these bubbles is the technology itself is good and has long-term positive implications and maybe even changes society. But usually what happens is the first incarnation doesn't work out. Like you look at even like a bubble that's bursting right now and like Bitcoin, that probably longer term, yes, a virtual currency that maybe has something backing it up rather than just nothing. That's one problem with Bitcoin too. That's encrypted and allows us to make transactions without fees going from currency to currency is probably a positive thing. But the first incarnation never is perfect. And, we had a video game bubble in the mid 80s. And of course, video games have ended up being a huge, huge business, in the 30 years since. But most of those companies in the mid 80s, actually about 99% of them did not survive. And I think that's where we are in 3D printing, that these machines can do an enormous amount of work. And, they're even talking about 3D printing doing things in the medical field, which is unbelievable. But it's not going to happen overnight, and there's probably going to be a bust beforehand because these companies have ridiculous valuations. You know, the internet was another example. The internet has really changed things for the positive in terms of business and the way we work in the last 15 to 20 years. But of course, most of those internet companies, the first ones, did not survive the bubble and bust of the early 2000s. So that's kind of where we are in 3D printing, that these companies have ridiculous valuations. Like I know one right now that I'm looking to short, it has $600 million market cap and $1 million in revenue. That's not profit, it's revenue. So that's kind of to the ridiculous point that we've got to in these stocks. And I think it's just like, again, when you print that much money, you have a misallocation of capital, and that capital can go into all these different sectors because, people are willing to take risks. And part of the reason is because you're suppressing interest rates, so people will go take risks in 3D printing and internet stocks and emerging market debt or whatever. So I think that is a bubble that will burst. I think that's the problem, is that all these things sound great. Well, the bubble's going on and the boom's going on and it's an amazing new technology, but they get pushed to valuations where many of these companies will never be able to fulfill it, or they'll fulfill it in 5 or 10 years.
Should we maybe buy a little piece of these high-tech companies then? Just on speculative purposes, but whatever you do, don't throw the whole kit and caboodle into it.
Right now, I actually would say probably no, because it's like if you would have bought some of these .com companies in 1998 before the huge bubble blow-off, you could have gotten, there's a difference between buying Amazon at 2 and Amazon at 100, right? So right now I would say no, because they're just all too heady valuations. Now, there's a couple maybe that have lagged and maybe that are cheap, maybe you could, but right now I would stay away just because they're up 3, 4, 500% year over year in the last 2-3 years, and I would just kind of wait. I just don't think you're missing very much at this point. You're missing maybe a short-term gain if these things have a couple more surges of 15, 20, 30%, but that's not worth the downside risk. Like, I used to, I don't subscribe to him anymore, but I used to read Jim Dines, and he called himself the first internet bug, and he had this list of 20 internet stocks. I remember this vividly in the late 90s, like 97, 98, that time frame I'm talking about. And he said if you buy say a couple $1,000s in all of them, and, most of them, if a lot of them don't even make out, you'll still be fine because of the huge growth in the internet in the next 15 to 20 years. And Dine's just right. Because I remember Amazon was one of the stocks on his list. If you had just put like $3,000 in Amazon in 1998 and the other 19 stocks went under, you would still be up an extraordinary amount of money because Amazon went up thousands of times. So, after splits and everything. So I think that it's really timing. Like if you would have bought some of these maybe in 2008, 2009, I would almost say, you know what? You might be able to hold through the next or bear market because you bought these things at a low enough level. But again, there's a difference between buying Apple at $90 in 2009 than buying Apple at $500 and some dollars here. So, and like I said, if you're a long-term holder, probably Apple here, you're okay holding through the next couple bear markets or whatever. But to buy these things at these heady prices, I just personally, I wouldn't do it right now. I actually am the opposite. I'm a value investor, so I like maximum, what John Templeton, my mentor, would say is maximum pessimism. I like buying markets when they're beat up. And when you buy beat up markets, ironically, you don't have to buy a hot stock or even a great company. You just can buy these quality companies in a market that's out of favor for whatever reason, and they can have the same kind of return. Like, for example, one of my holdings, which has done quite well, is when Greece was collapsing in 2012, I bought the telecom company there called Hellenic Telecom, and that has gone from $1 to $8 a share. which in percentage terms is good as almost any .com has done in those same 2 years. But that was an out of favor stock that it dropped from 16 to 1. So that's the kind of thing I prefer to do rather than, go chasing the next hot stock. Because, maybe the next hot stock can be a 5 or 10 bagger. But I rather find the out of favor stock that's dropped 70, 80, 90%. And then hopefully get that when the industry it's in or when the country it's in or whatever is turning around and making a major bottom, because I think your percentage returns are just as great and your risk is a lot lower at that point.
Dave, maybe remind our listeners what your website is and where they can find out more about what you believe in and what you don't.
Yeah, my website is www.addictedtoprofits.net. We have a free e-letter that you can subscribe to, and I do promotions and offers to the pay letter every couple months or so. And I would say that be a maximum pessimism guy, like I just said. And I know a lot of your listeners are kind of they're really into precious metals and gold and resources. And that's one of the sectors which I think is just turning higher right now. If you're interested in those sectors, my letter is probably of interest to your listeners right now.
After the break, Keith Schaefer on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Keith Schaefer, editor of Oil and Gas Investment Bulletin. Welcome to the show.
Thanks for having me, Jim.
First off the top, natural gas has done something nobody thought it would do over the last 3 months. What's the story there?
Well, really, it's all about the weather, and gas is always about the weather, and of course, North America this year has just been really hit hard, a winter like we haven't seen in 30 years. So really, it's just had so much draw for home heating that natural gas use has soared, and so with the price that's going up from about $3 per million cubic feet to over $5 in a very short period of time tells us is that the market was actually a lot tighter than we thought. So now we're in a position where all these companies, Jim, are raking in cash flow like they had never thought they would before, and it'll be really interesting to see what they do with that money this year.
Well, everybody's shocked when something happens, but of course, it's weather. I never heard of a polar vortex. I grew up in northern Alberta. It was just cold. They didn't have a fancy name for it.
Yeah, and because we've kind of forgotten what life used to be like back in the 70s, that's the name they've given it. But no matter how you spell it, it certainly is cold in most of the continent this year, and that has meant some huge draws out of natural gas storage. So much so, in fact, that now I think we're going to see a new higher floor price for natural gas through the spring, summer, and fall than we ever would have thought possible, only 6 weeks ago. So that has absolutely been the big turnaround story in energy in the last 3 months.
I'm sure the reason it happened is we thought we had lots laying around, in reserve.
Well, yes, and I think we do, and it's interesting to bring that up just because, in the futures market, all the months that are coming up here in winter, they have very high gas prices. But once you get back into the spring and summer, they're quite a bit lower, though certainly not as low as they were 6-8 weeks ago. So the market is saying here, Jim, that we don't believe that the gas market is really super tight. It's just going to be tighter than we thought, but it's not anywhere near a panic situation. So it'll be really interesting to see how the market responds to all this higher priced gas. If there's going to be a lot more gas come on stream now that's kind of been shut in because of low prices the last few years, I think that'll be the big question.
I can see infrastructure as well. All those people in the deep south of the U.S. were reminded sometimes winter visits. They'll be putting in furnaces. Things like that. There'll be more demand for natural gas simply because they've seen how useful it is.
Oh, absolutely. You are seeing, because of the low gas prices we've enjoyed over the last few years, Jim, you're seeing a lot more gas being used on a regular basis.
What about gas stoves?
Yeah, absolutely.
They cook better.
Absolutely. So what we're seeing now is a substantially higher demand level that's starting to get built in to meet all the rising supply we've had in the last few years.
Maybe we just got a little sloppy.
Well, I think that happens in every market, right? You get used to abundant, cheap things, and then at some point in time, it does run out. It does.
So, the future of natural gas better? Are we still going to have to rely on exports?
Well, I think that the U.S. still imports natural gas on a net basis, but certainly if we talk about what's going to take the price higher, now that all this LNG talk is out here, liquid natural gas getting exported to Asia off the U.S. coast, if gas goes much higher, Jim, I'm not sure that that's really going to fly. So it'll be interesting to see over the next year and a half what happens to the gas price and if that affects any prospects for these LNG terminals that are getting approved every month now.
A friend of mine asked, why aren't we running our cars and trucks on this?
Oh, it just costs a fortune to change everything over from oil to gas. You're talking about, you are seeing what I'd call the thin edge of the wedge in different places where you're starting to see some natural gas vehicles, and natural gas stations. But generally speaking, Jim, it just costs a fortune to change over that infrastructure. I don't see that happening in my kid's lifetime, honestly.
I don't know. I just thought if you had natural gas in your car, I could just gas up at home.
Yeah, that's true. You know what? And
I just need a compressor.
It could happen. Technology could make it happen. Right now, though, the way that we do things, to actually have a true natural gas station just wouldn't work.
Yeah, I grew up on a farm where, you innovate. So it wouldn't be impossible to do that. They switch fuel around all the time up there.
Yes.
Going on from natural gas, what's the next hottest thing?
Well, I think what's been interesting here over the last year, really, is ethanol. And most people don't think about ethanol that much. It's made from corn. It's just gasoline made from corn. But it has, the U.S. has to use 10% of their gasoline as ethanol now. And so what that means is the whole gasoline market is a little bit more dependent on the weather because, like natural gas, corn is dependent on the weather. And last year we had a bumper corn crop, Jim, the best the United States has ever had. And the U.S. is the big corn producer in the world, so corn prices went really, really low, which means ethanol profitability went really, really high.
I have a question. When they say they use corn, don't they use the entire plant, not just the head of it?
You know what, Jim, that's a good question. I wish I knew.
Because, just anything that's organic, a plant, you can grow alcohol from it.
Yes.
I bet you they just chop the whole damn thing up. Of course, the corn itself is rich in oil, which would give it more energy, but...
Well, they actually take the corn oil out and sell it as a food product.
Well, there you go. So they're just using the whole plant.
So, and what we're seeing now here, because corn is so cheap, they can make ethanol really cheap, and the profit margins for these ethanol producers is skyrocketing. They're having fantastic years. So, in Canada, we don't have any pure play ethanol producers. In the States, they've got 3 or 4. And the two that I'm following really closely, one is called Green Plains Renewable Energy, and it's out of Minnesota. That symbol is GPRE on the NASDAQ, and our subscribers got into that around $9. It's sitting around $24 today. So that's just in 1 year, it's gone from $9 to $24, and I think it's got a long way to go. Right now, they're making so much money, Jim. They just came out their last quarter. And if they keep this up, I can see the stock going quite a bit higher.
Is China going to be self-sufficient? We hear about shale in remote places. They'll have lots of natural gas. They won't need ours. Is that really true?
No, I don't see that happening, Jim. They're importing about 6.5 million barrels a day right now, and so that is just a lot of production to make up. So I don't see any of these big demand countries being self-sufficient. The U.S. is never going to be self-sufficient in oil, and neither will China. The shale revolution that we've seen here in the U.S., that took a very unique combination of innovation, ample services, available, drilling, fracking, all the other services that go along with drilling a well, and politically being able to move it all forward without any glitches. I don't see that happening anywhere else in the world ever again. Like, don't get me wrong, fracking and the shale revolution will spread, but it's going to spread really slowly. So the likelihood of China ever being energy self-sufficient through oil in our lifetime, there's no chance of that.
Will they ever lay a pipeline from Alberta to China?
I hope so, Jim. Like, honestly, that makes so much sense. You've got the oil sands, they're only about 1,000, 1,500 miles to the coast, and certainly transporting oil through a pipeline is much, much safer than doing it through rail.
And
so
the
it only
Bering
makes
Sea,
sense that...
I was going to say, too, the Bering Sea is very shallow.
Oh, you know, certainly going through the northern route.
I'm just thinking of D-Day. They built a pipeline. The code name was Pluto, pipeline under the ocean. And they shipped oil from England to Europe after the invasion. You can't bomb a pipeline. Their oil supply never dried up. And I'm just thinking, if they could do that back in the 40s, with our technology today, hell, we could build a tunnel to drive to China right now. Come on.
It's all about politics.
I'm still waiting for my flying car, though.
It's all about politics. And right now, the Canadian government has had a very laissez-faire approach to business here, and for the most part, that served Canadians well. But I do think they need to probably have a stronger hand. This is a very national interest pipeline that would literally mean billions of dollars a day to the country. So I'm not sure what they're waiting for to really step in and be proactive and start to make something happen.
I've seen several articles that say one of the holdbacks to Canada's economy is the fact that every pipeline, no matter how big or how small, is resisted always.
Yeah, we've got a culture here that we've allowed to develop where innovation is not rewarded like it could be, and prosperity isn't welcomed into people's lives like it should be. So it's really just a case of going out there and telling their story. And to be fair, the industry has done a very poor job both at listening to the population and as what their concerns are and communicating their message. So they kind of sit back and whatever environmental opposition comes up against them, they just go, yeah, well, there's more jobs, and that doesn't work. So they've been pretty slow to turn that ship around, and we're seeing the pain of that right now.
Well, the first thing they should do is hire somebody like the Suzuki Foundation, and who's the environmental consultant for the First Nations. Put those people right at the very front. What are your objections? We'll see if we can meet them and defeat them and work with you. And right now it's when they held public hearings where the public was excluded. I don't know. I think people don't have any faith in the process.
Yeah, I don't know if that happened. That doesn't.
That happened right here in Vancouver. The public was banned. You had to have, an affidavit from somebody with an escort of a sheriff to come into the place. A public meeting that's banned. It's incredible to think about that. But I know that's one of the reasons why people get uppity. They'd love to see a great Canadian economy, but have anybody assured us that they can ship this stuff safely. And so far, we watched trains explode and pipelines burst. I think the best message would be how many trillions of gallons or barrels, cubic meters are shipped safely every day. No one talks about that.
Yeah, it's true. And you know what? It's honestly, it's not new pipelines that would be the issue. It's the old pipelines. So that it just makes sense to have new pipelines carrying most of your crude.
I think, too, if you had people, I know they rely on machines and so on, maybe hire just a few more humans along the way. The human eye is still a marvelous thing.
Oh, there's lots of people working the oil sands, Jim. Oh, my God. It is the economic driver for all of rural Canada, so especially in the West. So when you go out to anywhere in rural Western Canada, the topic at all the barbecues is who's working in Fort Mac, what are they doing, what's their rotation. Like, people don't really understand where this country would be without the oil sands.
Yes, and I heard Peter Kent, the environment minister, say oil sands, greenhouse gases, 2 or 3 coal-powered power plants in Michigan emit more greenhouse gases than the entire Alberta oil sands. 3 power plants in the U.S.
That could be. I haven't heard that stat.
Oh, God. Well, really, they're burning coal.
They definitely are, yes.
They don't at the oil sands.
Mm-hmm.
So where are we going to go from here? We've atomic power, is that still a factor out there?
Nuclear in my mind has really gotten the short end of the stick here. Certainly because of the Fukushima disaster in Japan in 2011, the world made a very determined decision to reduce nuclear and increase natural gas. So that has been really a big savior for gas producers, that the worldwide gas price didn't go any lower. But you're starting to see some nuclear come back, certainly in Japan. The newly elected officials there were a pro-nuclear ticket, so that could be the thin edge of the wedge. It would certainly really help a lot of areas in Asia to get nuclear back online.
Well, locally, they were going to build 3 atomic power plants 3 miles north of my parents' farm in Peace River. After the tsunami, no interest in it anymore.
Yep, you got to determine which way the winds are blowing, that's for sure.
After atomic, I so wonder, though, about oil and gas. That's pretty basic for Canadians. Maybe people on the West Coast don't understand, although I did hear from an analyst say, BC's taking all the risk with shipping this oil, and what do we get for it?
Well, I think there's a lot of truth there, and what the industry is failing to realize is that now the general population wants a much more transparent way of dealing with that oil and making sure that there's very real and live, looked after, responsible cleanup solutions in case there ever is a spill, and the preventative solutions for it. There is technology out there, Jim, that would really improve the security and safety of pipelines. The industry is just choosing not to pay for it. So, when they start to do things like that, it really makes it difficult for them to gain public trust.
They really should say, money is no object. Whatever makes it safest, if we have to line the pipeline with titanium and platinum, we'll do it. I don't hear anybody saying that.
I don't know how long we'll have to wait to hear an oil man say that, but I'm going to...
I'll say yes, you have to be practical, but to ignore current technology, which improves every second of every day. We are living in an age where, right now, what's the technology double of knowledge? I remember it used to be 10 years, then 5, then 3. Now I think it's about 8 minutes. I'm making that number up, but I'm also not kidding. It's just incredible what we can do now.
It's true. It's true. The times are changing. Nothing's slowing down, that's for sure.
3D printing, we could be making the world's safest pipeline as you go along with a guy on a computer keyboard. This works best right here on these 3 inches. Again, technology blows your mind. If you're going to be investing in the oil and gas industry right now, what areas do you think are the hottest?
Well, I think that here in North America, we've cannibalized our gas price. We've produced so much gas that the price has dropped immensely, and I think that's actually close to happening with oil too. So I think you can pick some select producers, but I think you want to be very careful. I think the guys that are really going to benefit here over the next couple of years are the service companies. And that's the guys that do the drilling, the fracking, that supply the mud and fluids for the wells, and that do all the maintenance on the refineries and the pipelines. So those are the guys, in my mind, that really are going to be the big winners over the next 2 or 3 years in the energy sector.
I recall a big discussion on business television about that. People forget about the service industries. And my God, the equipment they have is super expensive, but super sophisticated and works very efficiently.
Oh, and there's new technology being developed all the time. So if you've got a better mousetrap, it'll spread like wildfire really fast if it's got a real, true benefit for the customer.
Yeah, I don't believe there are any roughnecks in oil. I don't mean that there aren't guys who do tough jobs, but they all have college educations now. They're very sophisticated about what they do. And I know personally from relatives, they wouldn't do anything they thought was bad for the environment, and that's good to hear.
Oh, absolutely. I think these guys get demonized ridiculously unfairly, where I think the industry needs to just buck up a little bit is, at a much higher level in the corporate structure, where there's got to be more attention paid to, the new social order that's coming around energy, and you got to be a lot more transparent. You got to be a lot more out there, and you're going to have to do some things that cost some money for the public good.
Thanks to our guests, Dave Skarica and Keith Schaefer, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more
This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.